Intercompany transfer of assets. Upstream sale of non-depreciable asset, land. In this learning objective, we're going to look at the consolidation accounting for year one when the sale takes place. We'll look at the eliminating entries, which include the current year activity between the parent and the sub, as well as the current year activity between the NCI and the sub. And then lastly, the sub's equity at book value. We'll pay attention to the special allocation entries, the unrealized gains and losses. This is the entry that was made during the year under the equity method of accounting. This represents 80% of the gain. And this is what the three-part worksheet would look like as it stands after EJE 1 is posted. What remains is the consolidated, in the consolidation column is the deferred portion of the gain. Now, as with other upstream transactions we saw with inventory, when we do the equity method of accounting during the year, we're only concerned with the parent. But when it comes to the elimination process, we have to reclassify or eliminate that equity method entry that we did, as well as assign the NCI their portion. We can see a couple of things with this three-part worksheet that we'll address a little bit later, and one is there's a gain of $89,000 and that the parent has the land on their records for $131,000. When we eliminate this, we'll take it into two parts. The first thing we're going to do is we're going to eliminate the income from sub. So we'll debit the investment account, $71,200, credit the income from sub, $71,200. And this eliminates the equity method entry we made during the year. The other portion of the entry is going to debit NCI, $17,800, credit income to NCI for $17,800. And what this does is it assigns the 20% of the deferred gain to the NCI, and it'll reduce any income to the NCI when we're all said and done and allocated everything out for consolidation purposes. Now we need to address any deferred gain or loss or unrealized gain or loss, same term. And we see that the deferred gain is there at $89,000. When we consolidate, that deferred gain needs to be eliminated. We also can see that the land is on the parent's records for $131,000. The value of the land is overstated, and as in the downstream transactions, the consolidated value should be no better or worse off than prior to the sale. So we need to reduce the value of the land. So what we're going to do is we're going to debit gain on sale of land. That will eliminate the gain. We're going to credit land for both for $89,000, and the credit to land of $89,000 will bring the lands to its correct value. We can see here we have two EJEs in the recap. And then we get a little clearer picture when we look at a partial three-part worksheet. We see that the income sub has been zeroed out. And we see with EJE 5 that the gain has been eliminated and the land has been restated to its correct value of $42,000. In the consolidated net income, we see that included in the sub's net income is $287,000. We'll subtract from it the deferred gain, and then the subsidiary's adjusted net income will be allocated out 20% to the NCI, and that 20% is reduced from the consolidated net income